We're going to jump right into rate the rates because the Federal Reserve Chair,
it's a big deal.
Jerome Powell, came on out and said, hey, we're going to do it again like we said we're going to do. And they did. I don't know why I went Southern with that, but I did. So here we go, guys. We are now looking at another 3/4 rate increase, which is no surprise, right? There's no surprise here. Inflation numbers were still high coming out of September. October numbers are very funny. They're going to come out next week, which is a little bit post-mortem. But here we go. We're going to do another 3/4% interest rate hike. Your home equity lines of credit, your credit cards, all that fun stuff just in time for the holidays is going to go up again. So that's fun. It's also what I believe is a reason why this is the first week that refinance applications have actually increased.
Whoa.
What? Are you kidding me? So refinance applications are actually on the increase. And I think what is driving that is cash out refinances.
Yeah.
Folks that have these credit cards that are now, they were down in the single digits, some of them. They were down at 10, 11%. Now with the 4% interest rates increase that we've seen, we're now 14, 15, 20%, depending on where you're at. So
yeah.
Refinance.
And really, do you want to spend, 16% interest on your credit card or 7% interest on your mortgage?
Yeah.
It's really a personal decision because it depends what your numbers look like and how long you plan on being in a place.
I'll tell you the fundamentals that I break down for my clients. I say your capacity to save is key, right? Your cash flow as a household is paramount. If you got yourself in a hole with credit card debt, own it, move through it, and figure out a better way to apply yourself, as well as if you can get over that hurdle and create savings on a monthly basis as opposed to just paying the popper and basically treading water, you're in a much better position. So that's what we do. We talk to people in this increasing rate environment and saying, hey, look, I get that mortgage rates are over here in the high 6s, mid 7s, and your credit cards are over here at 20%. Depending on how much in a balance you have, depending on where your first mortgage is at, we look at all of those numbers. And I hate to be the bearer of bad news in the giving season, but it's going to happen again in December. We're going to have another rate hike in December, though they are planting the seeds that it's going to be smaller, and then they're pretty much going to take their foot, the Fed I'm referring to, they're pretty much going to take their foot off the gas and just let it lie. So
they have been very, very open with us and have told the whole world we plan on raising rates this year. I mean, from the beginning of the year on, they have told us very vocally every single time. We want to jump back quickly to a previous episode and remind everybody that when they raise the rates, it's not the mortgage rates that they're raising.
Correct.
They're raising the T-bonds, the treasury bond rates.
Yep.
And that has a trickle effect on everything. Oftentimes it causes the mortgage rates to go up. However, we are in a recessionary period, or we're getting there.
We're still debating that.
The funny thing about recessions is you never know when they started until afterwards.
Right.